Okay, if I told you to close your eyes and picture the most exciting, the most explosive technology trade in the world right now, what pops into your head?
Probably something like flying taxis.
Flying taxis, right? Or humanoid robots, maybe a new NVIDIA chip that costs as much as a car.
Yeah, definitely.
You probably are not picturing USB drive or a memory card.
No, definitely not. Storage has always been seen as the plumbing of the tech world. It's necessary, sure. You need pipes. But is it exciting?
Not really.
Historically, no. It's a commodity. You buy it cheap and you forget about it.
Exactly. It's just background noise. But here's the thing, and this is why we're doing this deep dive today. That background noise just got deafeningly loud.
It did.
We're looking at the Q2 2026 earnings report from SanDisk. And, well, boring has officially left the building. We are talking about numbers that didn't just beat expectations.
No, they completely dismantled them. It's a fascinating case study, really. Here's a company that's been around, recently spun off again, and they just posted results that suggest a fundamental rewrite of how the entire industry works.
A rewrite.
Yeah. I mean, I've been analyzing hardware earnings for a long, long time, and you almost never see a mature company post numbers like this.
It feels like a glitch in the matrix.
Yeah.
So our mission today is to unpack this report. We've got the transcript from the January 29th call, the slide deck, the press releases, and all the headlines screaming things like SanDisk surges and blowout forecast.
Right.
We need to figure out how a storage company suddenly found itself at the cool kids table with the AI giants.
And to do that, we have to look past the big dollar signs, though. Believe me, those are impressive. And look at the structural shift that's happening inside the data center. That's where we'll understand why flash memory is suddenly one of the hottest commodities in the AI revolution.
Okay, but we have to start with those dollar signs because, they are just eye-watering. Let's talk about this holy snakes moment. The analysts on Wall Street, the people paid to guess these things, were expecting revenue around $2.67 billion.
Which is a respectable number.
Solid. And what did SanDisk actually put on the table?
They delivered $3.03 billion.
Wow.
Which is a massive beat in this industry, but the context is even crazier. That's up 31% from just the previous quarter.
In 3 months.
And up 61% compared to a year ago. For a hardware company, 61% growth is just...
That is wild. But the number that really made my jaw drop, the one that made me double check my screen, was the earnings per share, the EPS. The consensus was looking for about $3.31 a share. SanDisk came in at $6.20.
$6.20. They didn't just beat it, they nearly doubled it. It's a beat of almost $3 per share. You rarely see that. A beat is usually a few cents.
This is a different galaxy.
It is. But if you want to know what really got the market excited, the insight that tells you this isn't some fluke, you have to look at the margins. This is where the story shifts from just we sold more stuff to our business has fundamentally changed.
Okay, the gross margin. So this is basically how much money they keep after making the product.
Right. And context is everything here. In the hardware world, a 30% margin is pretty respectable. The previous quarter, SanDisk was at 29.9%.
Okay.
They guided, so they told investors to expect maybe 41 to 43%. And everyone thought that was pretty ambitious.
And the actual result?
51.1%.
Wait, what? That's a 20-point jump in profitability in 3 months.
Yeah.
How does that even happen? Did they find a pile of gold in the factory?
Financially speaking, kind of, yeah. And this is the critical part to understand. It wasn't just volume. Their bits sold, the actual amount of storage, was only up in the low single digits.
So they didn't sell that much more stuff.
No, this wasn't about flooding the market. This was all about pricing power and product mix. They were able to swap out low-margin commodity sales for these high-margin, high-performance strategic products. When demand outstrips supply this aggressively, the seller holds all the cards.
So they just sold significantly more expensive stuff to people who were desperate to buy it.
Exactly. It's a difference between selling 1 million economy cars and 1 million luxury sports cars. The volume is the same, but the profit is completely different. And all that extra price just flows straight to the bottom line.
And they are clearly playing those cards very well. They also cleaned up their bank account.
Yeah. They generated $843 million in free cash flow in one quarter. They paid down $750 million in debt. They're sitting on nearly $1 billion in net cash. So financially, they've gone from, managing leverage to absolutely bulletproof in about 90 days.
Okay, so bank account full, margins are fat. But why? CEO David Goekler, he had a really specific narrative on the call. He didn't say, oh, people are taking more photos. He pointed the finger at one thing.
AI. AI. This is the core of the deep dive right here. For years, the story of NAND flash memory was about smartphones and PCs. If iPhone sales were down, NAND was down. It was a consumer cycle.
Right.
Goekler is basically saying that era is over. AI is driving what he called a structural step up in demand.
And the numbers back him up. Data center revenue was up 64%, sequentially.
Which is huge. And here's the real aha moment from the report. For the first time in 2026, the data center is expected to become the single largest market for NAND flash.
It's overtaking PCs and smartphones.
It's a changing of the guard.
Yeah.
We are no longer in the mobile era of storage. We are in the AI era.
So I think most of us understand why AI needs fast chips, those NVIDIA GPUs everyone talks about. That's the brain. But help us understand why AI needs this specific type of storage. Isn't storage just where you put data when you're not using it, like a digital attic?
Well, that used to be the case. You'd store your photos on a hard drive and forget them. That's cold storage. But AI workloads, specifically inference, which is when the AI is actually thinking and giving you an answer,
Right.
that requires massive instant access to data. You can't have a super fast brain, the GPU, waiting around for a slow library, which is the storage.
So if the library's too slow, the genius brain is just sitting there twiddling its thumbs.
Exactly. And when that genius brain costs $40,000 a chip, you do not want it twiddling its thumbs. It's called starving the GPU. And to prevent that, NAND flash is becoming indispensable to the AI infrastructure. It's almost on the same level as the GPUs themselves now.
So they need the good stuff. They can't just buy the cheap USB drive chips.
No. They need high-performance Enterprise SSDs. SanDisk mentioned their BiCS8 technology node. This is their cutting-edge process. Their 8th generation of stacking memory cells vertically. And they're seeing massive demand for TLC drives, triple-level cell, which have the best balance of speed and endurance.
And they teased a new product, didn't they? Something with a cool sci-fi name.
Stargate.
Stargate, yes. Love the code names. What is that?
So Stargate is their upcoming BiCS8 QLC product. Now, typically, QLC or quad level cell is cheaper and slower because it packs more data in. But for AI inference, you often need massive capacity just for reading data, not writing it constantly.
Okay.
SanDisk has optimized Stargate to be a storage class product, so it's fast enough for AI, but it has the massive capacity of QLC.
So it's like a hybrid beast designed just for these giant AI models.
That's a good way to put it. They expect it to start shipping for revenue in the next few quarters. It really hits that sweet spot for the hyperscalers.
Yes.
Dense, power efficient, and fast enough to keep those GPUs fed.
So we have a product that is no longer just a commodity. It's a critical performance component. And that takes us to this structural evolution you mentioned. Because usually memory is famous for being a roller coaster, right?
Right.
Boom, bust, prices crash.
The hog cycle, yeah. Prices go up, everyone builds factories, supply floods the market, prices crash. Rinse and repeat for like 40 years. But SanDisk is arguing we're in a new era, specifically because of these hyperscalers, the Googles, Microsofts, Amazons of the world.
They're panicked about running out of storage.
Precisely. These giants cannot afford to have their AI roadmaps derailed because they can't get SSDs. So the buying behavior is changing. We're moving toward long-term agreements, LTAs.
So instead of calling up SanDisk every quarter and haggling over the price, they're signing multi-year contracts.
Yes, and this changes the power dynamic completely. SanDisk isn't just an order taker anymore, they're a strategic partner. They're telling customers, look, if you want guaranteed supply for 2027 or 2028, you need to commit now, and you need to pay for that certainty.
And the report mentioned prepayments, too. Customers are paying up front just to get in line.
That shows you the scarcity. And SanDisk made a very important point about supply. They expect demand to exceed supply beyond 2026. But, and this is key, they're keeping their CapEx, their spending on new factories, steady.
Wait. So demand is exploding, but they aren't rushing to build 10 new factories.
Yeah.
That seems counterintuitive.
It's disciplined. By keeping supply tight while demand soars, they keep prices high, they keep margins healthy. They are prioritizing what they call strategic customers, the ones who sign the LTAs, and basically allocating the scarce resources to them.
It's a velvet rope economy now.
It really is. It's like a nightclub. You can't just walk in anymore. You need a reservation.
And that reservation costs a premium.
A big one.
Now, we've talked a lot about the cloud and data centers, which is the sexy part of the story. But SanDisk is a household name.
I've got a SanDisk card in my camera right now. Is that part of the business dead? Not at all. In fact, their edge revenue, which is PCs, mobile, consumer, gaming, was $1.678 billion. That's still their biggest chunk of revenue.
Oh,
And
why?
it was up 21% sequentially.
So people are buying new laptops. Or is this an AI thing, too?
It's less about the number of laptops and more about the content per device. An AI PC, one of these new laptops with a neural processing unit, it just needs more storage. The OS is bigger. Local models take up space. So even if unit sales are flat, the gigabytes per laptop is skyrocketing.
And they're doing some fun stuff on the consumer side, too. I saw a mention of a plug-and-stay drive.
The SanDisk Extreme Fit, it's a tiny little USB-C drive, so small you just plug it into your laptop and leave it there. It instantly expands your storage without a bulky dongle hanging off the side.
That's actually really useful.
It's a simple idea, but it solves a real problem for people with maxed out MacBooks.
Yeah.
And they're leaning into brand partnerships too.
Crayola and FIFA, right?
Crayola and FIFA, yeah. Licensed products for the 2026 World Cup. And they're really pushing gaming. They rebranded their WD Black and WD Blue lines into SanDisk Optimus, which they showed off at CES this year.
Optimus, very Transformers. Fits with Stargate.
It does.
I like the branding.
Yes.
It seems like they're trying to make storage feel cool.
They're trying to humanize the brand. It's smart. If you're a gamer, you don't want storage, you want performance. Rebranding to Optimus speaks to that. They want you to buy their drive, not just the cheapest one on the shelf.
Okay, let's pivot to strategy. We talked about factories. SanDisk doesn't do this alone. They have a huge partnership with Kioxia in Japan.
The joint venture, the JV, it's crucial. And they just announced they've extended this partnership all the way through 2034.
That's a long marriage in tech years.
It guarantees them supply for the next decade. But, like everything in this report, there's a cost. SanDisk committed to paying Kioxia about $1.165 billion between 2026 and 2029 for manufacturing services.
Ouch. $1 billion with a B. That sounds like a penalty.
It sounds like a lot, but think of it as the price of admission, or like capacity reservation fees. In a world where supply security is everything, paying $1 billion over 3 years to guarantee you have the chips to sell. That's a strategic investment.
Fair point. Okay, we have to talk about the guidance for next quarter, Q3. Because if Q2 was a holy schnikes moment, Q3 is, I don't even know what to call it.
It is unprecedented. They're
Yeah.
forecasting revenue between $4.4 billion and $4.8 billion. Just remember, they just did $3.03 billion.
So another massive jump. But the margin guidance, please say the number so I know I didn't just hallucinate it.
They are forecasting a gross margin of 65 to 67%.
67% gross margin.
Right.
For hardware.
Yeah.
That's software territory. That's Adobe margins. That's like selling downloadable codes, not physical chips.
It really just highlights the scarcity premium. When you have a product that everyone needs to run their AI empire, and there isn't enough of it, you can price it for value. To go from 30% margin to nearly 70% in 2 or 3 quarters, I've followed this industry a long time. You almost never see a reset this violent to the upside.
It's incredible. It basically confirms that for the next 6 months at least, SanDisk can charge whatever they want. But we have to play devil's advocate. What could go wrong? Is there a catch?
There are always risks. The biggest one operationally is allocation. When you have to tell customers, sorry, I can't fill your order, or I can only give you half of what you want, you risk upsetting people.
You burn bridges.
You do. Managing those relationships when you are the bottleneck is really tricky.
And I guess if the AI boom suddenly cools off.
Exactly. The whole thesis rests on this structural step up in AI demand being real and sustained. If the hyperscalers suddenly say, you know what, we have enough inference capacity, we're pausing our build out, then those 67% margins will come down just as fast as they went up.
Gravity still applies.
Gravity always applies. Eventually. But for right now, SanDisk is surfing a tsunami.
So let's wrap this up. We started this whole deep dive by saying storage is boring.
And I think we've learned that in 2026, boring infrastructure is actually strategic gold.
If you're looking at the tech landscape, the takeaway here seems to be, look for the bottlenecks.
Absolutely. The AI revolution isn't just about the smart algorithm or the flashy robot. It's about the physical constraints, power, cooling, and yes, memory. When performance hits a wall, the thing that breaks down that wall becomes the most valuable asset in the room.
And right now, that wall is data access speed. And SanDisk has the sledgehammer.
I like that image. From background noise to the main event, a classic underdog story, really.
It is. The component everyone took for granted is now the one everyone is fighting over. So before we sign off, I want to leave you with a final thought. We talked about these long-term agreements, the giants like Google and Amazon locking up supply for years, paying up front, securing their future.
Right, they're building a fortress of data capability. They're kind of privatizing the supply chains.
So if data center storage is becoming a scarce strategic asset, like energy or precious metals, and the price of admission is a multi-year billion-dollar contract, what happens to the little guy? What happens to the startup with a brilliant AI idea, but no supply chain clout?
That's a very unsettling and a very real possibility.
Are we seeing a future where only the giants can afford to remember their data?
We might be heading toward a sort of data aristocracy where only the biggest players can play.
Something to think about while you plug in your SanDisk Extreme Fit. Thanks for listening to The Deep Dive. We'll catch you on the next one.